What's up, effortless investors, and welcome back to the channel. If you're new here, this channel is all about steady, consistent, low-stress investing. Perfect if you're starting with small amounts or just want something realistic. In today's video, I'm breaking down how much my £2,000 dividend portfolio paid me in December 2025. We'll look at dividends, growth, what I bought and sold, and which investments pulled their weight and which ones absolutely did not. As always, this is real money, real results, and hopefully a realistic benchmark if you're building a portfolio on a budget. I'm not a financial advisor, just a 9-to-5 guy building wealth the effortless way. Timestamps are in the description if you want to skip straight to the dividend portion of the video, but that's enough rambling, let's get into it. And we start our check-in on the portfolio with a look at how December treated us. As of the end of December, the portfolio is sitting at £2,291.93. For the month, we finished slightly down by 0.2%, which works out to a very dramatic £5.38 loss. So yes, one coffee's worth of volatility. Zooming out a bit though, things look much healthier. Overall, the portfolio is still up 10.58%, which is an unrealized gain of £219.01 since starting. Quiet progress, no fireworks, and that's exactly the plan. Now here's a fun little stat for the year. 2025 finished with 6 positive months and 6 negative months. A perfectly balanced investing diet. I'll pop a chart on the screen now showing the monthly ups and downs, because it's a good reminder that investing isn't a straight line up. Some months you win, some months you wobble, but over time the trend is what matters. Now let's see how this portfolio is getting on compared to the plan. Right now, the portfolio is up 10.58%, which is an unrealized gain of £219.01, giving us a total value of £2,291.93. In other words, we're currently ahead of schedule, and I'll happily take that. For comparison, based on my long-term projection, at this stage, the portfolio only needed to be up around 7.5%, or £110.96, which would have put the value at roughly £2,010.76. So I'm comfortably ahead. But before anyone thinks I've cracked the investing code, a quick reality check. That projection assumes starting with £100, then adding £100 every single month, all the way until I'm 60 years old. No magic, no market timing, just consistency and a lot of patience. So this isn't about beating the market every month, it's about staying on track, letting time do the heavy lifting, and occasionally being pleasantly surprised when things go a bit better than expected. This month's buy and sell activity was eventful in the most underwhelming way possible. Thanks to Unilever's recent stock split, I was automatically gifted 0.1145 shares of Magnum ice cream, worth a grand total of £1.23. A surprise to be sure, but not one I asked for. Since Magnum ice cream isn't something I actually wanted to hold in the portfolio, I promptly sold the shares. Technically, this resulted in a £1.23 profit, which might just be the most efficient trade ever. There was no strategy shift, no dramatic exit, just a bit of housekeeping after a corporate reshuffle. The portfolio remains focused on the same long-term plan, minus one very small ice cream position. So, with the world's smallest ice cream empire now officially sold and out of the way, let's move on to something a bit more substantial, the EI growth pie. This is the part of the portfolio that's built purely for long-term growth, and in December it had a slightly sleepy month. The growth pie finished down 0.4%. which works out to a £6.31 dip. Nothing dramatic, just a wobble on the way up. Zooming out though, the bigger picture still looks very healthy. Overall, the growth pie is up 12.53%, or £171.11 since inception. Breaking that down with a look at the individual assets, VWRL is up 11.32% overall, which is a gain of £109.67. but was down 0.22% in December. EQQQ is up 15.47% overall, with an unrealized gain of £61.44. All of that in spite of being down 0.97% in December. So both holdings took a small step back in December, but over the long term, they're still marching in the right direction. As usual, this pie also received its regular £65 investment from the £100 deposited this month, keeping everything ticking along nicely with no tinkering required. Slow, steady, some might say slightly boring, yet exactly what a growth portfolio should behave. So after the growth pie did its best impression of one step back, two steps later, let's move over to the EI income pie, where things were a bit more cheerful in December. This part of the portfolio finished the month up 1.2%, adding £6.43 in unrealised gain, which is a nice surprise from an income-focused setup when markets are feeling a little moody. Overall, the income pie is now up 5.61%, or £28.11, and quietly going about its business. Let's take a quick look at the individual assets, starting with JGGI, which had a perfectly still December at 0%, but is up 4.43% overall, the investing equivalent of standing very calmly in a crowded room. VHYL did what VHYL does best, rising 0.68% in December, now up 8.63% overall. BAE Systems bounced back nicely this month, up 3.85%, though it's still down 1.96% overall, proving that recovery is a process. British American Tobacco had a rough December, down 5.11%, but zooming out, it's still up a hefty 15.03% overall. Very much a long-term smoker in the portfolio. BT Group crept up 1.52% in December, sitting up 4.73% overall. Not a bad return so far from one of the newest assets in the pie. One of the other newer assets, HSBC, had a strong month, up 9.85%, and is now up 17.26% overall. TSLD barely moved this month at 0.04%, but remains down 3.16% overall, still finding its footing, but it's really here for the level of monthly income it provides. JEQP dipped 0.44% in December, but is up 5.66% overall. JEIP slipped 1.6% this month, though it's still up 1.23% overall. Both these JP Morgan funds are monthly payers, so I would expect their growth potential to be lesser than some of the other assets in this pie. Legal and General had a strong December, up 6.12%, now up 8.03% overall. National Grid edged up 0.09%, sitting at 8.95% up overall. Unilever had a tougher time, down 5.01% in December and down 5.72% overall. This drop came largely after the recent stock split, though it has recovered slightly since, so it's one to keep an eye on rather than panic over. All in all, the income pie did exactly what it's meant to do. Keep things steady, paid its way, and didn't demand any drama. Which, for a dividend pie, is a compliment. So after all that sensible, dependable income behaviour, it's time to briefly leave the comfort zone and visit the portfolio's spicier corner. ARKK is very much the hold on to your hat position in this portfolio, and December reminded us of that. For the month, ARKK finished down 1.33%, having a bit of a wobble as the year wrapped up. That said, zooming out again, as we always should, it's still up 3.13% overall, which works out to a £3.87 gain since being added to the portfolio. So yes, it dipped in December, but ARKK continues to do what ARKK does best. Move around a lot, test your patience, and occasionally reward it, so long as it stays a small, controlled slice of the overall pie. A bit of spice is fine, you just don't want it to be the main course. So after ARKK gave us a gentle reminder that excitement cuts both ways, we now arrive at the full sci-fi corner of the portfolio. Rigetti Computing had a very choppy December, finishing the month down 12.83%. Definitely not for the faint-hearted, and not something you'd want to check daily. But, zooming right out, this is where things get interesting. Overall, Rigetti is still up a staggering 154.01%, which works out to a £15.37 gain on a very small position. This is the textbook definition of a speculative growth holding. Big upside, big swings, and absolutely not something the portfolio relies on for stability or income. If it goes to zero, the portfolio shrugs. If it keeps running, great. Either way, it earns its place by being small, controlled, and emotionally optional, which is exactly how I like my speculative bets. So after quantum computers, disruptive tech, and the occasional portfolio wobble, it's time for my favourite part of the update. The bit that actually pays me for waiting. December was a very good month for dividends. In fact, this was the best dividend month so far for the portfolio, which feels like a nice way to wrap up the year. Here's who chipped in. Nintendo starts us off with 9 pence. BAE Systems follows with 13 pence. HSBC delivered 14 pence. JEIP delivered 15 pence. Unilever delivered 17 pence. JEQP delivered 21 pence, followed by EQQQ with 31 pence. SMIF delivered a respectable 35 pence, followed by VHYL at 75 pence. Finishing with the top three as always, TSLD starts us off with £1.10 in dividends. JGGI delivers its biggest dividend to date of £1.21. But in first place is VWRL with a whopping £3.53 and the single largest dividend payment to date. No single payment is life-changing, but together they add up, and that's kind of the whole point. I'll throw a chart up on screen now showing dividend income for each month this year, because it's a great visual reminder that income growth isn't instant. It's gradual, a bit lumpy, and then suddenly you hit a month like this. Slowly, quietly, the snowball rolls on. So after counting up all those lovely little dividend payments, it's only fair we hand out a gold star for December. The best performing asset this month was HSBC, which managed a 9.85% gain in December, which is a very respectable month by any standard, and it didn't stop there. On top of the share price gains, it also paid a 14 pence dividend, so it really did turn up with the gifts. This is exactly why boring, old, unfashionable stocks still earn a place in my portfolio. No hype, no headlines, just steady income, solid performance, and the occasional month where they quietly steal the show. Not flashy, not exciting, just effective. Now, after handing out praise where it was due, we also need a gentle must-try harder award for December. The worst performing asset this month was, once again, Rigetti Computing. Rigetti finished December down 12.83%, making this the second month in a row it's claimed the bottom spot. Consistency is usually a good thing, just not in this direction. That said, this is exactly what a high-risk, speculative position looks like in real life. Big moves, sharp drops, and the occasional test of your patience. Because it's a small holding, the portfolio can absorb these swings without any real damage, which is precisely why position size matters. So no panic, no changes, just a reminder that excitement and volatility often come as a package deal. So that's where the portfolio ends the year. Some wins, some wobbles, a few dividends along the way, and absolutely nothing that required panic, caffeine, or dramatic music. This portfolio was built with small, steady contributions and a very long-term mindset. And month by month, it's quietly doing exactly what it's supposed to do. Not flashy, not exciting, just effective. If you're investing with limited capital, or you're just getting started, I hope this shows that you don't need to swing for the fences. You just need to stay in the game. If you found the video useful, give it a like. It really helps the channel. Subscribe to Effortless Investor if you want to follow along with the monthly updates, dividend progress, and realistic investing without the hype. Thanks for watching, and I'll see you in the next one, where we keep things slow, steady, and refreshingly boring.